Everyone, we are back again. We'll just wait for another couple of more seconds so that we don't want any of you to miss the insights that we have from our experts today. So please bear with us for another couple of seconds and then we can see a lot of people joining in. Hi, Lee. Hi. Hi, Michelle. Yeah, thanks all of you for joining in. Great. So let's not keep you waiting and we are just going ahead with the session. So good morning, good afternoon, and good evening to all those who joined us. I welcome you to today's session on revenue lifecycle maturity in 2026. Why revenue control weakens beyond deal closures. Once again, thank you all for joining us today. Over the past decade, enterprises have heavily invested in CRM, CPQ, and billing platforms to improve deal execution and pricing visibility. Yet, in 2026, many organizations still struggle with revenue leakage, billing inaccuracies, and fragmented lifecycle visibility. Now, that challenge is no longer deals. It's ensuring revenue is realized, governed, and sustained across the entire lifecycle. Well, in today's session, we'll explore where revenue execution breaks beyond deal closure, how monetization complexity is reshaping operations, and what revenue leaders must rethink to build more predictable and scalable revenue models. Well, I'm pleased to introduce you to our speakers today, Sanjeevi C. Ramachandran, Vice President and Lead Analyst here at QKS Group. We have Abhishek Dubey, Principal Analyst for Revenue Lifecycle Management. Well, together they will share practical insights on strengthening revenue governance and lifecycle control in 2026. We also encourage all of you to raise any questions that you may have throughout the session in the Q&A section below, and we'll surely address those towards the end of the session. With that, let's get started and over to you, Sanjeevi.
Thank you, Anish, and welcome everyone. Hello, Dubey. So, before we get into the substance, we'll just take a moment to look at the left side of the slide. This is pretty much the conversation most CROs are having right now. The pipeline is strong. That part is definitely working. Margins, not quite at the same level of enthusiasm as the pipeline. And forecast misses, they are really not really coming from the pipeline anymore. They are coming from what happens after the deal closes, right? And then the board comes in. And the questions, this is the moment the questions shift to revenue quality, and which, if we are honest, deal stage metrics are not exactly designed to answer that question, right? And at the same time, we are introducing you more monetization models as well. Subscriptions, usage, hybrid, and all of that is great for growth. But what happens is, in the end, governance tends to lag just a bit behind, usually trying to catch up while the business has already moved on. If this is sounding familiar, that's actually a good thing. It means we are talking about a real pattern. It's not an isolated issue, because what's changing in 2026 is not that revenue is harder to generate. Teams are still selling big time. Deals are still closing big time. The shift is exactly what happens next. Revenue has actually become harder to control. Once it moves beyond the deal moment, it is very, very hard to control. Earlier, we used to assume, right, if the deal is right, the outcome will follow. Now, what we are saying is very different. The deal is right, and things still move. Not immediately, not dramatically, just gradually across execution. So, what we see is that the deal is no longer where revenue outcomes are fully determined. It is where they begin to drift. This is the place where they exactly begin to drift. And that gap between what was designed in the deal and what actually gets realized over time, that's exactly what we are going to unpack today. So on the right, you'll see a quick view of how we will structure this. We will start with where this pressure is coming from. Then we will look at where revenue actually leaks during execution. And we will introduce a simple framework, the revenue control gradient, to give this a bit more structure. Because it also explains why control feels strong right up to the point where it is not strong. Then we will talk about what good governance looks like in practice. And we will then close with a quick diagnostic, probably 3 or 4 questions you can take back and use immediately. They are simple questions, but they tend to open up some very interesting discussions internally. I mean, which is what we have seen across multiple webinars we have conducted on this topic. So CROs are accountable for a number which they do not control completely, right? So I know that that's a very or slightly uncomfortable statement, and I want to be very clear about what it means and what it does not mean, because it's very easy to hear that and think that this is a criticism of revenue leadership from my end, but it is not. This is not about CROs failing. It is not about weak sales execution, and it is definitely not about pointing fingers at any one team. And what it is. If you look at what it is actually a structural reality. The number a CRO commits to the board, to the investors, to the business is increasingly shaped by things that happen after the deal is closed. And many of those things don't actually sit within direct CRO control. If you just walk through what happens after a deal is signed, right, it becomes very obvious. Pricing gets approved, and it makes perfect sense at that time. Then it moves into contract management, where it gets translated into legal and commercial terms. Then it moves into billing, where it gets translated again, slightly a bit differently. Sometimes slightly differently, sometimes creatively differently. And then the customers use the product, and they don't use it. They don't always use it the way we forecasted, right? Amendments happen mid-cycle, and each one of these amendments are perfectly justified and individually approved. And then renewal comes around. And this is when the market has its own opinion about your original pricing. And now, here's the important part. None of this is a failure. Everyone involved is doing their job correctly, responsibly, and within their scope. But when you step back and look at it end to end, the economics shift. The gap between what was designed at the deal and what actually gets realized over time, that gap becomes very real. And more importantly, it's very structural as well. In our early 2026 conversations with revenue leaders across, say, manufacturing or SaaS and telcos, right? This did not come up as a big dramatic issue. It came up as something much more interesting. It was more like a quiet pattern, something people are starting to notice, starting to talk about, and now starting to figure out how to fix, because the deal was correct and the number still moved. That's what today is about. And Anish, did we receive any questions till now?
Well, so far, we are seeing a lot of curious people, but no questions yet. We're
Great.
just waiting
I'm
for
looking forward to a
answer.
lot
I
of
mean,
questions.
yeah, good that Sanjeev, you reminded the attendees that they can always raise any questions that they may have during a conversation in the Q&A section below. And we encourage all of you to please drop your questions, because these sessions are curated especially for you. And yeah, over to you guys. I mean, I'm not
Thank
interrupting
you,
you
thank
guys.
you, thank you, Anish. I mean, let me be a bit more specific here, because revenue is getting more complex. Okay, when we say that, it sounds very intelligent, but it doesn't really help anyone. So what I want to do instead is walk through 3 pressures we keep seeking. So across conversations, evaluations, and just repeated patterns. And the most important thing here is none of these are pipeline problems. None of these are sales problems. These are pure execution problems. If you look at the first pressure, pressure one, the forecast variance, right? Forecast variance is no longer coming from pipeline. Now, for years, almost by default, when a number is missed, we all knew where the conversation would go. Pipeline. Was it enough? Was it qualified properly? Did the deals move fast enough? Who delayed? All of these are very valid questions. And to be clear, pipeline discipline is still important. No one is getting out of that. But what's changing is this. The miss is not starting at the front anymore. It's starting after the deal closes, which is where the challenge also comes up. We will have amendments that change the original structure, and usage comes in below what was projected. And renewals do not hold the pricing logic from a year ago. So everything looked fine at close. Pipeline was very strong and forecast looked solid. Everyone was happy, and then the number moved. Because between close and realization, a lot of things happened that the forecast model never really accounted for. And that's the shift. If the problem is pipeline, it's a sales fix. If the problem is post-signature execution, it's a governance problem. So we are talking about a governance problem, and the conversation has now become very different. It's a very different conversation, and it's a very different ownership. And if we move to the second pressure point, so which is about the margin compression, which quietly accumulates, and it is more subtle. And if I have to be honest with you, it is more dangerous as well, because margins usually don't drop because of one big mistake. No one wakes up and says, let's reduce margin by 8% this year. Let's reduce margin by 20% this year. No. What actually happens is a series of very, very reasonable decisions. An amendment will make sense. A billing adjustment will look fair enough. A renewal discount has been given to retain an account. Each one of these reasons are justified. Each one is approved. And individually, all of these looks perfectly rational. And nobody steps back and asks, across everything we have done to this deal over the past 12 months, what is the total economic impact? That question almost never gets asked. And that's exactly the margin compression sits. So the voice of customer surveys that we do as part of QKS Group's initiative, the voice of customer data actually shows that 61% of enterprises actually are seeing margin diverge from deal assumptions without anyone being able to point a single thing that went wrong, which is actually the perfect definition of a structural problem. And the third pressure point is the most strategic, which is about monetization complexity, completely and totally outpacing governance. So all of us who's part of this webinar, right? We know that commercially things have evolved a lot. Subscription models, usage-based pricing, hybrid contracts, outcome-based models. Honestly, this is all fantastic progress. We get a lot of flexibility, and there is quite an amount of better kind of alignment with customers. But what is the trade-off? And the trade-off is something we don't always talk about. Every new model introduces more translation points. That is a trade-off. What was designed commercially now has to be interpreted by systems, contract systems, billing platforms, revenue recognition, each with their own interpretation of reality. And every one of those handoffs is a potential point where things can actually drift. We are seeing about 58 dot some percentage of organizations actually say that they need system customization just to support new pricing models, which is basically the market saying we are innovating faster on the front end than how we can govern on the back end. Right? Innovation is much more faster than the governance, and this gap, it never stays constant, right? It widens and it keeps widening. And if you step back, these pressures that we discussed, right? Forecast issues moving post close, margin compression happening cumulatively, and monetization complexity actually outpacing governance. None of these are dramatic failures, and that is what makes them tricky, very tricky. All these pressure points are structural, consistent, and they quietly shape the outcomes. So, and let me hand over to Abhishek here. He is going to take this one step further and show where this actually shows up operationally.
Well, Sanjeev, just to put it across here, thank you for bringing across this slide along with the VOC resonance data points. To all our viewers, do check out our VOC resonance, which is available in our research library at qksgroup.com. There are much more pressure points which has been identified in the report. If you find it struggle, if you're struggling to find the report in our website, just drop in a message into our contact support, and we'll surely share those report to you. With that, again, over to you, Dubey.
Thank you. Thank you, Anis. And thank you, Sanjeevi. So basically, talking about the pressure points. So basically, what's useful about those three pressures is that like they point to specific execution layer. So let me be very concrete about where this actually happens. So because once you see it mapped out, it becomes much harder to ignore. So the title, if you see the slide, carries a specific claim. So I want to highlight before I walk through the 5 points. So revenue does not leak at approval; it leaks in executions, and that's an important distinction because most governance investment is concentrated at approval, and approval is working. But the problem is that approval alone is not sufficient governance. So let me walk you through each of these 5 points and explain the mechanism. So not just the statistics. So the first one, the configuration without margin guardrails. So think about what happens at very start of a deal. So basically, a salesperson open a CPQ system and start configuring an offer. So in a well-governed environment, that configuration layer enforces commercial policies. It knows like which products can be combined, what the floor pricing is, what the margin thresholds apply. But in a less well like governed environment, the configuration layer allows the deal to be built without those constraints. And the margin validation only happens later at approval. So the problem with this approach is that by the time the deal reaches the approval, the structure is already set, and it's much harder to like redesign a deal at approval than it's to prevent bad economics from being configured in the first place. So according to our POC survey, 74% of our respondents are in that second situations, like building deals before the guardrails apply. And that's not a pricing failure. It's a configuration architecture failure. And it means like every deal starts with potential drift already in place. And the second one is like pricing logic lost in the billing translation. And this one is like genuinely underestimated. When a like pricing team approves a deal, they are approving a pricing construct, but the construct then has to be operationalized in a billing system, and then billing systems are already complex. They have their own logic, their own rate tables, like their own rules for how to handle edge cases. So what gets approved as a pricing model and what gets configured in billing are often not identical, and the gap between them, like while it may be small in any like for the single invoices, but it compounds over the term of like multi-year contract into something material. And 61% responded flag this as a frequent occurrence. So in a, like for example, in a 3 year SaaS enterprise deal, a billing translation gap even half a percent per quarter adds up to something that shows like upon the board's revenue quality questions. The third one is like usage diverging from forecast. And this is particularly, I'll say, acute in subscription and consumption model. So when a deal is structured, someone builds a users model. And here, how much we expect these customers to consume. Here's the like revenue curve we are projecting, but customers are not models, so they behave differently. They can adopt like features more slowly than expected, or ramp some consumption faster than forecasted, or they can downgrade like usage midterm for any reasons like entirely unrelated to the deal structure, and the revenue realization curve shifts accordingly. So here nobody did anything wrong, the model just didn't predict the reality precisely. And in a portfolio of dozens or hundreds of accounts, those individual variances aggregate. Now, if you see the fourth, like mid-cycle amendment untracked totally, so almost every enterprise has an amendment governance process. You need approval to change a contract. There is a workflow, there is a sign off, and it's documented. So the governance exists, but almost no organization has a like view of what all the amendments to given a deal, or like to given a segment of deals have done cumulatively, like to totally to the original economics, and every changes gets reviewed in isolation. So the question that's almost never asked, and that Sanjeevi also covered. So what is the combined effect of the amendment plus the three, like before it on the deal we actually approved maybe 12 months ago? So the governance is event based and the impact is cumulative. So that is a mismatch where drift lives. Coming to the fifth point, renewable economics resetting assumptions. So at renewables, competitive pressures create a very specific dynamic. The account team knows the customer has options, and leadership wants to retain the account and to give a discount by offering a discount, and a bundle gets restructured, pricing gets adjusted downward then, and in most cases, these are reasonable commercial decisions. But if renewable pricing is not explicitly tracked against the economics, like of those commercial decisions, so like the original deal, and if there is no governance question that asks, does the renewable preserve the like ARR and the margin assumption we built into forecast, then each renewable cycle gradually erodes, like it erodes the economic foundation of the like the deal, and it happens quarter after quarter. Slowly it happens, and the main like headline, if you see, none of these five like individually cases of causes like a failure event. Each one is like a rational decision in its own context. But the problem is that no one is governing the economic like thread that runs through like all these five, and that is what the revenue control gradients explains. So moving to the next slide, Anish. Yeah. So the revenue control gradient, you can see, came out of something like we kept observing in CPQ and pricing evaluation like over the past couple of years. So a structural pattern that kept showing up regardless like of industry, regardless of company size, regardless of like which system were in use. So I want to like walk you through this framework carefully because it gives a structural shape to everything like Sanjeevi has described in the pressures point. So let me orient you to the visual. So you can see the horizontal x-axis. That is the revenue life cycle, and reading from left to right, like monetization design, the demand generation, deal structuring, contract encoding, monetization execution, revenue analytics, and finally the capital and investor confidence. So this is end-to-end journey of a piece of a revenue from the moment like commercially strategy is set all the way through to how it registers as a value at the board and investor levels. And the vertical axis is relatively governance intensity, how concentrated, how strong, how it continuously enforced is like how continuously enforces governance control at each stage of that cycle. So this is conceptually scale. It is not statistically measurement, but the shape it describes is deeply consistent with what we observe across the enterprises. And now look at the curve itself. So starting on the left at monetization design, governance intensity begin at the moderate level. But as you move toward deal structuring, the curve rises and it reaches at peak, like the highest point on the chart, you can see right there at deal structuring. That is where pricing is reviewed, where discounts are approved, like where margin is validated, and like where commercial terms are checked. So this is the tightest, most concentrated moment of governance control in the entire life cycle, revenue life cycle. And that makes the complete sense. Like organizations have invested heavily in this moment. And deal desk pricing committees, approval metrics, CPQ configuration, all of that infrastructure is designed to make the deal structuring moment as controlled as possible. And it works. So basically governance at deal approval, is very strong in most enterprises. But now watch the curve does like immediately after deal structuring. It drops so sharply through contract encoding because commercial intent is now now being interpreted by contract system rather than held by the original deal team. So it continues dropping through monetization execution, and that is the trough of this curve. So the lowest governance intensity point in the life cycle, and which is precisely where Sanjeevi 3 points sit. So there is a slight recovery at revenue analytics,
Hmm.
and which represents reactive oversight. So variance being detected after it has already happened, and then the curve flattens as you approach capital and investor confidence. So one more thing I want to emphasize before we move on. So this is not a model that assigns the blame. So the people managing contracts, configuring billing, processing amendments, leading renewals, they are not failing. They are doing their jobs within their systems. The gap exists not because of individual failure, but because of the governance was designed for a simpler revenue model. And as the model is getting complex, and revenue models you can see every year it is getting complex faster than the governance architecture. The architecture has to evolve to match it. So that is the structural reality. And now Sanjeevi will connect this to what it means specifically for the CRO.
It's an interesting slide just to put it across. We are seeing a lot of curious people asking a lot of questions regarding this, and I'm sure that they are more curious to hear what Sanjeevi has to say on this. I guess somehow your mic is probably in mute.
Uh, yeah, so my
Yeah,
bad.
loud and clear.
So, so I actually want to use this slide to make this a bit more personal. Okay. So, because it is always one thing to look at a model and say, yes, that makes sense. It is another to look at it and think, this is exactly what my role feels like right now. So, if you could look at the left side first, so this is what CRO accountability looked like for a long time. So pipeline, win rates, bookings, forecast accuracy at deal close, what is the sales performance, what was the pricing discipline at approval, very, very deal centric. You structure the deal correctly, you close it, the number goes to the board or goes on the board. And the assumption was pretty straightforward. If the deal is governed well, the revenue will flow. And to be fair, that assumption was not completely wrong. It did work. It worked because most models were simpler. Fixed pricing, fixed terms, and not a lot happening mid-cycle. So governing the deal was enough. Now, now look at the right side. So this is what CRO's accountability actually looks like in this year, 2026. Margin predictability should be across the life cycle. ARR integrity that goes beyond the deal. Renewal economics versus original assumptions. Revenue quality post-close. And governance across systems, cross-functional ownership, you name it, it is all there. This is not deal governance anymore. This is life cycle accountability for a CRO. And here is where it gets even more interesting. So to manage this now, you will need visibility across systems and functions that historically were never really part of a CRO's world. Billing, contract management, revenue analytics, renewals, and finance. Each of these has its own system, its own goals, its own reporting time, and occasionally its own version of what correct looks like. But collectively, they actually determine whether your number actually holds. So what's happened is quite simple. The mandate has expanded to cover the full life cycle, but the architecture, which is actually the systems, the ownership and decision rights, was built for a deal-centric world. And it has not caught up. And this is the line I want you to really, really pay attention to, please. From our early 2026 VOC research, About 63% of senior revenue leaders say they feel accountable for outcomes that they cannot directly govern through existing systems. Accountable for, but cannot directly govern. That's the tension. High accountability, but control is distributed. And that's not a leadership issue at all. It's an architecture issue. This is what happens when responsibility expands. When I say expands, when responsibility expands much faster than the systems and structures that are supporting it. Um, of course, we have a good news. This is solvable, not just with one tool, not with one organizational change, but then it is solvable. And it actually starts, the solution actually starts with understanding what life cycle continuity actually requires. So let's move on to that and talk about what the shift actually looks like. Um, sorry. So let me start with something I see almost every time this conversation comes up. When organizations look at these gaps, the first instinct is we need better technology, better CPQ, better billing, better analytics. Basically, one platform to fix the last platform. Sorry, one more platform to fix the last platform. And to be fair, technology is only part of the answer. But it is not core of the problem, which means it is not the core of the solution also. This is fundamentally a governance design problem and not a tooling problem at all. So, and if we look at the left side, which is event-based control, you govern at the deal approval stage. Execution is expected to follow the deal structure. Each event, whether it's amendments, billing, renewals, they get reviewed independently. Analytics tell you something went wrong after it has already gone wrong. And control happens at specific moments, not continuously. Let me be very clear about something. This model is not broken. It was designed for a simpler, smaller revenue environment. Fixed pricing, fixed terms, very little movement once the deal was signed. In that world, if you governed the deal well, you were done. The deal was the control point. Now let's look at the right side. This is what today's environment actually demands. Subscription models where revenue plays out over time. Usage based pricing where customer behavior actually shapes the outcomes, and hybrid contracts mixing multiple models, and mid-cycle changes, which are now normal. They were considered as exceptions at a point in time, but then now they are the new normal. Mid-cycle changes, and then we have renewals where pricing gets renegotiated under pressure. And in this world, the deal is just the starting point. So governance cannot be treated episodic anymore. It has to be continuous, and that's what the right side is describing. You have to define economic intent once, and then you have to preserve it across the life cycle. Governance is built into the architecture. Not They should not be added as checkpoints. Governance are not checkpoints. They must be built into the architecture, and then you track the cumulative impact of decisions. And it should not be like we are approving a decision one by one. We need to look at the cumulative impact. And AI, artificial intelligence, right? It operates inside governance, not outside it doing its own thing. And the most important thing, ownership actually becomes cross-functional. From code all the way to renewal, the ownership becomes cross-functional. And if I have to say this very directly, I would say that this is a governance ownership decision. You can buy every tool in the stack and still operate in an event-based model. So let's get to the real question, right? Who owns economic continuity across the life cycle? How are those responsibilities connected? This is not a system decision. This is a leadership decision, and it starts with the CRO. And it does not sit with the CRO alone. We spoke about cross-functional ownership, right? It requires alignment across sales, finance, product, operations, and all the teams that usually agree eventually. So now, naturally, the next question is, okay, if we get this right, what actually changes? What does it look like on the other side? Let me show you that. So let's move to the next slide, Anish. So this slide will show us 6 outcomes. I'm not going to walk through all 6 because not all 6 matter equally in a CRO conversation. Let me focus on the ones that actually change how you operate and how you show up in front of the board. First one is a predictable ARR. Everyone wants a predictable ARR, and that is not new. What is new is what is that predictability going to be based on? In most organizations today, ARR predictability is still tied to deal assumptions. What we modeled at close, what we expected to happen. And then we spend the next few months explaining why reality had other ideas, very different from what we thought is going to come true. In a life cycle governance model, that changes. Predictability is no longer based on what we thought would happen. It is based on what is actually happening in billing, in usage, in amendments. So the forecast is not a one time projection, it becomes a continuously updated view of reality. Which means when you go to the board and say this is the number, you're not saying it with hope, you are saying it with control. And the second one is going to be margin integrity across the life cycle. I want to be very specific here. The goal is not just better margins, that's too generic. The shift has to be that margin compression becomes visible early and manageable in real time. Right now, from what we see in the market, in a lot of organizations, margin compression is still something that you discover. Finance closes the quarter, runs the numbers, and then comes back and says something moved. And then everyone goes into investigation mode. Which amendment, which discount, which billing adjustment, and it ends up becoming a forensic exercise. By the time you understand it, it's already done. With lifecycle governance, that flips. You can see compression forming as it happens. And more importantly, you can see it at that moment decisions are being made. So instead of explaining margin erosion after the fact, you will be managing it before it actually compounds. That's a very different level of control. And the third one is board level revenue quality confidence. This is where everything comes together because ultimately this is what the board cares about. They are not just asking what's the number. Their questions are going to be more around how reliable is the number, how stable is the margin, what's the quality of our recurring revenue. And a lot of organizations today, these questions do not get precise answers, they get explanations, well-reasoned explanations, but only explanations and still explanations. In a governance lifecycle model, things are different. You can answer those questions precisely because you are not estimating from deal assumptions. You are reflecting governed execution. And that difference between explaining the number and standing behind it is very visible, both at board level as well as at the investor level, and increasingly at valuation level, because revenue quality is becoming a signal. Organizations that can consistently show that what they design is what they realize, then they are building an advantage that's not easy to replicate quickly. So naturally, the next question is, what does it actually take to get there? What does the governance architecture need to look like in practice? Abhishek, over to you.
Thank you, Sanjeevi. So, yeah, basically, this slide is the CRO governance operating model, and you can see the 6 layers of the revenue stack. And for each layer, what governance continuity actually requires. So, not what tool to buy, but what discipline, what ownership, what architectural decisions is needed. So going to cover the most three, like all are the three important, but what the end users are talking about mostly are the layer 4, layer 5, and layer 6. So basically, layer 4 is about the billing and revenue execution, and this is the deepest point of the dispersion corridor and requires the most structural investment. So, like approved pricing logic needs to be preserved intact into the billing, should not be interpreted, not approximated. And uses and amendments need to be governed cumulatively so that the billing system is reflecting the governed deal economics rather than like its own operational defaults. Layer 5 like talk about the revenue analytics and oversight, and you can see the governance shifts here like from reactive to predictive. So most like analytics today can tell you what happened last quarter, but the aspiration is analytics like that tell you what is happening now and what will happen if like current trends continue. So that requires analytics connected to the full life cycle, full revenue life cycle, not just like transaction level reporting. And it requires someone who owns the question like that are realized economics tracking against designed economics, while the layer 6 talks about the capital and investor confidence, and this is the aggregation of all the others. So if the five layers you can see like it, below it are governed continuously, the output is revenue quality metrics. So that like that answers the board level questions precisely. Predictability, margin stability, recurring revenue quality, these becomes demonstrable, not asserted. So the practical question this slide, if you see, raises is in your organization, who owns the economic thread through each of these layers, not who owns the systems. So basically, who is accountable for whether economic continuity is maintained as revenue moves from layer one layer to the next. And that accountability map is what separates level 2 maturity from level 4, and which is exactly like what I am going to show you now. Next slide, Anish. So basically, yeah, yeah. So this spectrum, like you can see, connects directly to the revenue control gradient. I think you missed the slide, Anish. The revenue
I think
governance matrix.
there is a small network error that is happening. I
Yeah,
hope I'm in the right slide right now.
yeah. Thank you, Anish. So you can see this spectrum connects directly to the revenue control gradient that we have showed earlier. So as you move up to the maturity levels, like from level 1 to level 4, the governance dispersion corridor in the gradient narrows, and like the curves moves toward a higher, more continuous level of governance intensity across the full life cycle. So let me walk through this four level briefly. So because I think the more like important thing is not just to describe, but to help you locate where your organization actually sits. So you can see the level one is deal centric control. Strong approval governance is there, like revenue control at signature, execution assumed to follow. And the gradient shows high governance at deal structuring and like steep deep drop forward. So this is where many organizations were 5 years ago and where some still are right now. So there is nothing wrong with this model for a like simpler commercial environment. It's I'll say it's not sufficient for 2026. And if you see the level two, that is like connected governance, if you have like CPQ contracts and billings are interconnected with each other. So there is a proper data flow between the system. But again, the governance is still fragmented. Each system is managed within its own operational context, and the economic thread is not continuously tracked. So manual correction, like after deal close, is common in these second level. So according to analysis, like 47% of our early like 2026 VOC respondent sit here, and like majority of the enterprises, and that amber marker is sitting right over like level 2. So I want to be very clear here. So basically, level 2 is not a failure state. It represents real investment, real progress, real capability. It is significantly more mature than level 1, but it is also not sufficient for the commercial complexity for like 2026. And the gap between level 2 and level 3 is one that more and more CROs are being asked to close. So level 3 is life cycle visibility. Analytics provide like genuine visibility across the life cycle, but oversight is still reactive. Variance is detected rather than prevented. So in this, according to our VOC research, 24% of the respondent where they on this level, and this is where the leading enterprises are today. And then coming to the level 4, that is like governed life cycle architecture. So economic intent preserved end to end here, and governance continues from code to renewal. And 7% of the respondent were at that level only. So this is the target state for you, and it is achievable, though not without deliberate architecture decisions. So I want to ask, like, where does your organization sit? And this is the question, like, worth sitting for a moment. So because the answer shapes what the next conversation inside your organization needs to be. So now there is one more dimension to the maturity picture that we need to address directly, and it's like mostly common now, that is artificial intelligence. So AI keeps coming like in every conversation about revenue maturity. And I, as an analyst, I want to give it to like genuinely honest treatment rather than I do not want to promote it. Yeah. So I want to just start by being like direct about something. This is like not anti-AI slide. AI is delivering like genuinely value across the revenue life cycle. And the blue bars you can see on this chart shows where. So pricing and configuration, you can see the 72% it has a high impact. In quoting and approval, around like 65%. So these are like meaningful contributions that are already changing how revenue teams operate, like guided selling, deal risk flagging, discount optimization, approval prediction. These are real capabilities that real organizations are benefiting from right now with help of AI. So let's start there. Like AI works, but the question is, under what condition does it work well? So if you'll see uh, the bar of like green color, so those are the governance gaps actually. So situations like where AI is operating in ways that introduce risk rather than reduce it. So around 41% of the organizations have situations like where AI pricing recommendation can override governance guardrails without an audit trail. So meaning the system is making commercial suggestions that bypasses the controls human put in place. And often even no one knows it like happened until after the fact. And as you move right across the life cycle, like into the contract and amendment, billing, execution, in renewals, you can see the blue graph, it's becoming the shorter, and the green bar is becoming the taller. So the further you move from the like the deal structuring movement, the lower AI readiness is, and the higher governance gaps becomes. So billing AI operating AI operates outside like revenue governance architecture, and in that 71% have we have the data. So AI renewal pricing disconnected from the original deal economics. And here is the principle I want to like leave you with on this slide. So because I think it's the most practical important thing about AI in revenue governance. And like AI amplifies whatever governance condition it operates within. And if I talk about in a well-governed revenue environment, clear accountability structure, margin guardrails in place, where cumulative impact tracked. So there AI can accelerate the value realization. It makes good governance faster, more scalable. But in poorly governed environment, like where the ownership is fragmented, reactive oversight, and the cumulative drift untracked, and there the AI like accelerate the functions. It makes the leakage faster and harder to detect. So now the question for like you can be asking like uh, for your organization looking to invest in AI, uh, should you use AI? So it is not about using the AI. It is about it is like you should answer like it is our governance architecture ready to support AI or not. And most organizations at level two maturity are not yet in position to get the most from AI in billing contracts and renewal, precisely because the governance layer beneath those functions are not yet continuous. And that brings us to what I think is the most practically useful part of the session, like something you can take away and use today, the 2026 revenue governance diagnostic. And I think Sanjeevi can provide more detailed insights on that.
All right. So, Anish, so I mean, let me close this section with something that's very practical and useful for 190 and odd users who have joined this webinar. Right? I mean, I'm going to leave them with 5 questions, which they would be able to take back and answer about their own organization within a week, and ideally without too many debates. So the first question is always: does pricing logic at the code stage travel intact into billing? What I mean to ask here is, without manual correction, is the pricing logic at the code stage traveling intact into billing? If it is not that, then there is definitely a gap between what was approved and what is actually invoiced. And that gap will always have a number attached to it. And it is going to be troublesome and problematic in the longer run. Question number 2: are mid-cycle amendments governed for cumulative margin impact, or is your organization just approving one at a time? Because drift is building up quietly if the mid-cycle amendments are not governed. Everything is approved, but the outcome is not really governed. It doesn't make sense from a profitability point for an organization. The question number 3 that we need to ask inward is renewal pricing tracked against original deal economics? If not, you are slowly reshaping your ARR without explicitly deciding to do so. The question number 4 that you need to ask yourself is, does AI sit inside your governance architecture or operating alongside it? If not, you are actually increasing the execution speed and leakage at the same time. This is not an AI problem. This is a governance problem. And question number 5, which is the most important one: who actually owns economic continuity after the deal is signed? When I ask this question, I mean across contracts, billing, usage, and renewals. If you if you don't have a clear answer to these 5 questions, then it means that accountability exists, control does not exist. So I would strongly recommend taking these 5 questions into your next revenue leadership discussion, not as a problem statement, just as a quick health check. I mean, they'll tell you very quickly where to focus. Abhishek, over to you. And thank you very much, everyone.
Thank you, sir, and thank you, Sanjeevi. So, before we open to questions, Anis, I want to like as an analyst, I want to highlight something like what we are actively researching this year. So, because what it connects directly to what we have discussed. So, we are running like 6 studies in the revenue and monetization market, and you can see 3 of them are like CPQ studies, CPQ manufacturing, CPQ telco, and commercial and subscription CPQ. And we are also covering like B2B price optimization, which like sits at the margin intelligence layer, like of the governance stack before and during deal structuring. And we also covering the revenue lifecycle management suite, which is the like the convergence architecture connecting quoting, contract, billing, and renewals as like one governed systems. And lastly, like we are also covering subscription and SaaS billing management, like which is the layer where execution leakage most commonly originates. And each of these like directly maps to the governance layer in the operating model that we have showed to you. So if you would like any like early findings from any of these studies, or would you like to be involved as a research like participant, please reach out to like Anis or QKS Group or me directly. So you can see the details on the last slide. And with that, let me hand to our moderator Anis for the questions.
Yeah, so thanks Tuve for taking us through the active researches that is going on right now. And Sanjeev, thank you so much for leaving our audience with those throat-provoking questions that they that keeps in their mind. And I'm sure they're gonna I've noticed that a lot of screenshots have been taken, especially on those slides. So thanks for sharing that as well. Now, coming back to those questions, as mentioned before, we do have curious people around the revenue control gradient that was discussed earlier. So the first question that has come regarding that is the revenue control gradient shows governance speaking at a deal structuring.
Hmm.
But according to your experience, where does that control break down first? Is it the contract encoding or the billing translations or is it the renewals?
I
Who would
think
like to
I'll
take
take,
this up?
yeah, I'll take it. So I think my answer is contract encoding. So because that's where the translation of deal intent into the operational terms begins. So the deal team who negotiated the economics is typically not the same team encoding the contract. And the gap between what was intended commercially and what gets written into the contract terms is often where the first meaningful drifts appear. Yeah, I think that's my answer. But yeah, in manufacturing, I like it tends to be the contract amendments tied to engineering change orders. But
Hmm.
in SaaS, like I see mid-cycle plan modification as the most common early break. So there is no single answer like that is the right across all environment, which is part of why the governance stack needs to be built per layer.
Thanks for answering that, Abhishek. As we are running short of time, I would like to just take a one last question, which is based on governance, and I think the right person for this would be Sanjeevi. Should
So depends
enterprises
depends on the question, Anish, and the difficulty level.
so the question, I'll just walk you through the question. So the person is asking, should enterprises fix governance architecture before deploying AI, or can they happen simultaneously? I think this is mainly come up because of the fact that there is a lot of situation where we said AI or the technology is not the problem, but governance is, right? So I believe Sanjeevi, you probably could be the right person to answer this.
Uh, got it. I just got lost in translation for a minute. Can you
So I'll just repeat the question again.
yes, please?
So the person is asking, should enterprises fix governance architecture before deploying AI, or can it happen simultaneously?
Ah, okay. Okay, got it, got it. See, simultaneously is possible. Okay. So simultaneous is definitely possible, but what is key is in terms of how you sequence within the simultaneous approach. So it depends on what AI use cases operate in well-governed layers. If you look at a pricing configuration or deal risk flagging and deploy there first. So look at low risk, high value, and then hold off on AI and billing and renewals until the governance beneath those layers is stronger. I mean, we did ask the question about governance, right? It was one of those five questions because AI in a well-governed layer would actually accelerate value for the organizations, and AI in a poorly governed layer is going to be definitely the opposite. It's going to be complete dysfunction. Okay, so it's better that the organization start with AI where you already have continuous governance and use the AI deployment process to build governance in the layers where it does not exist. So simultaneously is definitely possible, but sequencing, like I said, is going to be a big thing within simultaneous approach in terms of what AI use cases operate in well-governed layers.
Thanks for sharing that, Sanjeevi. And I would like to wind up today's session to all those unanswered questions. We'll surely revert back to those via mails. And as we conclude our session today, I'd like to sincerely thank all of you that has joined us today. And I'm sure we have a lot of people, like Sanjeev mentioned sometime back, we saw peak till 190 people attending our webinar sometime. So that's thank you so much for attending and joining us today and being a part of the discussion. Today's conversation really highlighted that revenue management 2026 is no longer about closing deals, but rather it's about governing the entire revenue lifecycle to ensure accuracy, consistency, and predictability. Now, let's say from pricing discipline to contract to bill alignment, strengthening execution across the life cycle is critical to reducing leakage and driving sustainable growth. A special thanks to our speakers today, Sanjeevi and Abhishek, for sharing your valuable insights and taking us through the revenue gradient. And those perspectives help how organizations can build stronger governance-driven revenue operations. And once again, to all our attendees, thank you for your time, thank you for your engagement, and thank you for your questions. Do stay updated with our latest research, our VOC resonance, the values that has been shown some time back. Check out those reports. Do follow us on LinkedIn and visit our website at qksgroup.com. We look forward to having you in our upcoming sessions. Once again, thank you and have a very great evening.
Thank you very much, Anish. Thank you, everyone. And thanks to
Thank you, Sanjeev.